Hello, good afternoon everyone, and welcome to Professional Advisors Working Lunch, brought to you courtesy of our partner Baillie Gifford. I'm Katrina LLoyd, Editor-in-Chief of Professional Advisor, coming to you from a very hot London, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through our usual housekeeping today. I'm going to switch the slide over, there we go. So I should inform you that this session is being recorded, and we'll send you a link of the recording by tomorrow, and do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So let's get on with the session today. I'm delighted to be joined today by Seb Petit. He's Investment Specialist Director of Baillie Gifford's Responsible Global Equity Income Fund. There are plenty of ways to make a quick buck, but in the pursuit of long-term wealth creation, Seb thinks we should be more tortoise than hare. Investing is an endurance sport after all. So in this presentation, he'll consider the business models and behavioural characteristics required to stay the course, and why focusing on companies committed to dividend growth is an underrated approach if you want to steadily compound wealth over long periods. Do feel free to put your questions to Seb using the chat function, which you'll find at the bottom of the screen, and we'll try and put as many of those questions as we can to him after he's finished the presentation. So just before I hand over to Seb, I just want to go through the learning objectives for today. So by the end of this session, delegates will be able to develop an understanding of a steady growth approach, understand the behavioural characteristics required to invest for the long term, learn where there are opportunities for steady growth and dividend growth investments in the coming years. So that's the CPD covered. Just a reminder about those questions and to put those in the chat function at the bottom. So now I'm very pleased to hand over to Baillie Gifford's Seb Petit. Afternoon, Seb.
Good afternoon, and good afternoon, everyone. Thank you very much for dialing in today. So in the next 25 minutes or so, I'll talk about our strategy, responsible global equity income strategy, which is, maybe a less well-known strategy, outside Baillie Gifford, which is more, known for its high growth strategies. But certainly, we do run, quite a lot of different sort of strategies which are focused more on the steady long-term compounding of earnings and dividends, and today's strategy is one of those. So just going back to the synopsis, we invest more like a tortoise, trying to steady compound returns for you and your clients over the very long term. So first I'll give a brief overview of that strategy, and then we'll go into the details about what we think is important, how we go about finding those long-term compounders that we think can deliver great returns over the very long term. But let me start with this sort of overview, and what we show here is essentially in blue at the top of the boxes, what we look for in companies. We look for growth companies with sustainable business models that pay resilient dividends, and we hold them for the long term. So this is the headline, and let me just give a little bit more details on each of those boxes. So the first aspect is we look for growth companies, and we look for what we call relentless compounders. Out of 5,000, investable companies in the investable universe, we try to find those that can deliver over the next 5 to 10 years, approximately, 10% EPS growth per annum, because we think that if they can do that, the share price will follow and comfortably outperform the market. The second aspect is the sustainable business model. And what we mean by that is not only a strong franchise and a strong competitive moat, but it's also in terms of ESG credentials. And the reason is, if you want to be a long-term compounder, you have to be mindful of the ESG challenges, and you have to be ready to adapt and address those challenges so that you can maintain, your earnings and dividend growth over the long term. The third aspect is the resilience of your business and the resilience of your dividends. And we think that's important because over the next 10 years, there will be another crisis. And we want to be sure that companies in the portfolio can, go through a crisis relatively unscathed. And the proof point we show here is that in the pandemic, 9 out of the top 10 holdings actually grew their dividends that year, in a year when global income was down 15%. So we think, again, to compound earnings and dividends over the long term, you have to have a certain type of business models and resilience, which is critical. And finally, the long-term investment horizon is again quite important. We think the market is relatively efficient on quite a short-term basis, but a longer term there are market inefficiencies, which is what we are trying to address here. So overall, by investing in these relentless compounders which have a quality growth bias, we think we can deliver returns and the volatility of returns, which is attractive to two types of clients. And essentially we have two types of clients coming to us. The first one is clients looking for income, and an income that can grow in real terms over the long term. And then we have a second client base, which comes to us more for the total return approach, and the fact that the quality growth bias of the portfolio gives it, a steady return with lower volatility than global equity markets. And this is something they appreciate. We sometimes call it a swan fund, sleep well at night fund. So these are overall the characteristics that we look for in companies. But let me address first the dividend growth question and why we think that dividend growth is a great signal of these long-term compounders that we look for. And essentially, if you think about it, for a company to commit to dividend growth for the next 5 to 10 years, they have to have certain characteristics which makes them, great candidates to be long-term compounders. You have to have a long, runway for growth. You have to have great management. You have to have a very strong moat, competitive moat. And finally, you have to be managed relatively conservatively and with prudence, so that when there is a crisis, you can still pay that dividend. Now, that approach on dividend growth as a signal of compounding, is there is evidence that it works, if you like. So the chart here shows the dividend aristocrat sub-index of the S&P 500. Which is essentially composed of companies which have grown their dividends for 25 years, over time. And what you can see is that as a group, that subset of the index has comfortably outperformed the S&P 500 over time, and not only since 1989 when the index started, but over any 10-year period you look at that. Those groups, this group of dividend growers would outperform the S&P 500. So we think there is evidence that focusing on dividend growth is a great way to outperform the market. Now, we know that compounding is valuable. We know that it can deliver great returns over the long term. The problem we have is that compounding or finding those long-term compounders is getting harder. And what we show here on the chart on the left-hand side is the average lifespan of a company in the S&P 500. And as you can see, it has been going down over the past decades and is now sitting around 15 years. So if you look for companies that can deliver earnings and dividend growth for the next 10 to 20 years, there are less and less of them. So it's getting harder and harder. Now, we show two examples of companies that were thought of as long-term compounders and have disappeared over the years. So one is GE, which at some point nobody could believe would disappear essentially, and they were the archetypal long-term compounder. But it shows you that even for what is considered a best-in-class company, you can, fail and actually disappear. And it's true also of new business models that emerge that seem very promising, but and show all the hallmarks of potentially being a great long-term compounder, but then sometimes fail. And WeWork is a great example of that. When they launched, they seem to have a wonderful business model that would promise many years of dividend and earnings compounding, but in fact they failed. So it is difficult, and it's getting harder and harder to be a long-term compounder. Now, how do we go about trying to identify and invest in these long-term compounders? We don't think they are silver bullets. We don't think they are, key sort of characteristics that make it easy to identify those. So the way we think about it is we think of it as trying to raise the odds of finding those by focusing on the 4 elements that you see on this slide. So the first one is moats. And to be a long-term compounder, you have to have a strong competitive moat. You have to have a great franchise. And ideally, you would have 2 or 3 of these competitive moats. An example here is Microsoft, which we have held in the portfolio since 2010, and is a great example of a company which started with a moat around the Microsoft Office and Windows, and essentially betting on the fact that people would hesitate to train onto a new sort of Excel-like software, just because it was a little bit cheaper. And so that was one aspect of their strong moats. The second aspect was that if you wanted to share documents with your clients, you wanted to make sure they were able to read it. And so you wanted to send a Word document that someone else could read. And that created a network effect for Microsoft, which was their first moat. Now, with the cash flows generated from that moat, they invested in Azure, the cloud business first, which created another moat for them. And then more recently, they invested in OpenAI and now are rolling out ChatGPT through their different software to clients. And that, again, is creating another moat for them. So they now have 3 competitive moats. And again, that raises the odds of them being a long-term compounder. The second thing we think companies need to have is a long runway for growth. Again, if you want to deliver earnings and dividend growth for the next decade, you have to have the opportunity, you have to have an addressable market to have the opportunity to do that. So an example here is Novo Nordisk, the Danish pharmaceutical company, which we've held since 2016. And this is a company which is leading in the insulin market, and then recently have launched the first drugs against obesity, Ozempic and Wegovy. Now, what's interesting here is that there are about 800 million obese people in the world, and at the moment, having started about 2 years ago, Novo Nordisk is only sort of delivering, drugs to less than 15 million of these people. So less than 2% of the addressable population is currently covered by Novo Nordisk drugs. That gives you an idea of the number of years they can grow, at very, strong rates without reaching out, without running out of patients, if you like. The third element is people. Again, we think management, but also the culture of a company can be very, good indicators of long-term compounders. So the example I would take here is L'Oreal, the French cosmetics company. It's in a portfolio, and it's a company which, when we did some research into it, particularly into the culture, speaking to employees or former employees, what struck us was how entrepreneurial, how ambitious, and how sort of hardworking people were. A very flat structure. People very willing to try new things, innovate, and that's what has allowed the company to be so successful over the years, but also to keep delivering in an industry very prone to fashion trends and very difficult to keep on top of for many years. And L'Oreal has been able to do that, we think, in part thanks to their very strong culture. And finally, the last element, which we think is a good hint as to whether a company could be a long-term compounder, is prudence and the way it is managed, the strength of the balance sheet, because this is what will matter, not very often, but once in a while in a big crisis like a great financial crisis or the pandemic. These will be very important to make sure the company can keep delivering earnings and dividend growth. Now, the example we take here is Caring, which is a company which was in the portfolio until very recently, and we just have sold because it is already operationally relatively highly geared. It's quite a cyclical industry. Gucci is the main brand, and it's quite a cyclical industry. But on top of that, they've recently added debts to the balance sheet, and their business has become more financially levered. So we think that is, if all goes well, it's not going to be an issue. But if there is, a major crisis, that will, stop them from being able to pay a dividend. So we think that's a warning sign. So we have sold out of the company. So again, these four elements is not a silver bullet, but it just raises the odds, we think, of finding these long-term compounders. Now, what differentiates us from the market? And we think we have, quite a different mindset. In the market, you have, people who are, focused on certain things, which is different for us. So if you look for example, in terms of insights, a lot of people in the market, focus on the PMIs. This is a monthly, macroeconomic indicator, which get, many people very excited about, and brokers, sell, write a lot of notes around these PMI numbers, but actually, in terms of impact on, the companies and their ability to deliver earnings growth, it's very limited. So rather than focusing on the PMI, we prefer to spend our time and energy on, investigative research, and the type of which I mentioned about, L'Oreal, for example. We also think there is a difference in terms of sort of approach to investment. Whereas Mr. Market thinks in terms of target price, and brokers will say, you should, buy L'Oreal at 20 and sell at 40. We think there's a very transactional way of looking at things. Whereas, fundamentally, we believe if the earnings and dividends grow over the long term at a very, good rate, the share price will follow. In the middle, you will have some variation in the valuation multiple, which may explain some of the share price moves. But over the long term, the fundamentals will win. So that's why we want to focus on, the 5-year compound earnings growth or dividend growth of companies, rather than, fixing a target price for the next 3 months. And finally, there is a very big difference, we believe, between us and the average market participant in terms of incentives. A lot of asset manager and portfolio managers out there are incentivized on a 1 to 2, 3 year, relative performance. And we think that introduces inherently a short-term bias to management, which we don't think is very conducive to producing attractive returns over the long term. So our managers are incentivized on the 5-year, rolling periods of relative returns to global equity markets, but also on income growth delivered compared to the UK CPI, because it is one of the objectives of the strategy. So again, these long-term incentives, which are permitted because we are a private partnership, differentiates us, most, we believe, from other market participants. Now, this is the mindset, and I just wanted now to go back to the portfolio and what it looks like for the fund at the moment. So you see here all the names in the portfolio. We're arranged by sort of yield buckets, which you can see on the x-axis, and then we have colors, by company, and essentially these colors are a subjective classification, a type of growth that we, categorize companies with. As you can see, the bulk of the portfolio is composed of what we call compounding machines in light blue. So these are, very strong franchises with great management, great runways for growth, very strong balance sheet, and very resilient because they've been through many different cycles over the years. So you see companies like L'Oreal and Microsoft, which I've mentioned already, but you see the Nestle's, Procter & Gamble, or TSMC in there, for example. So these will always be the backbone of the portfolio, will always be, very resilient and providing, the resilience in more challenging environments. And then we supplement that typically with a second group, which is smaller in size, but is important to boost earnings and dividend growth of the strategy, which is what we call exceptional growth opportunities. So these are, companies who need to reinvest in their business to grow, and typically we expect faster growth of these businesses, and we hope some of them, will become compounding machines in the future. And then we have two much smaller categories which are there to help, diversify the fund's income and capital growth over the years. All these companies in the portfolio that you see here, fit the sentence I used at the start. They are growth businesses with sustainable business models, very resilient dividends, and we hold them for the long term. Now, I want to take a step back from the individual names, just to give you a snapshot of the portfolio, at the portfolio level, just to have a better view of what it looks like in aggregate. And what we show here in blue is, the metrics for the portfolio compared to the metrics for the benchmark in gray. And I just want to focus on two of them. The first one is the return on equity, which you can see in the fund is much higher than the benchmark and is typically much higher. That is the quality bias I mentioned previously. We want these companies to not only be able to pay a growing dividend to shareholders, but also to have enough returns on their investment that they can pay that dividend and reinvest in their business, because that is the only way for them to grow and deliver that growth we expect from them. The second metric I want to focus on is the debt to equity ratio, which typically in the fund will also always be, much lower than the benchmark. And the reason is we want, as I said, our companies to be prudently managed. We want them to have a strong balance sheet, because inevitably that crisis will come, and in that crisis we want them to be able to sort of be strong, survive, and potentially widen the gap with their competitors. So this is a metric that hasn't really mattered over the last 10 years because interest rates were so low, liquidity was plentiful, so it wasn't an issue. But now that rates have risen, our competitor companies that compete with our holdings will face a much higher sort of pressure on their cash flows and will use more of their cash flow to pay down the debt. And that means our holdings will be in a comparatively positive competitive position compared to those businesses. Finally, I want to highlight the chart, the bar chart on the top right side here, which is the delivered volatility for the strategy compared to the benchmark. And again, typically it has been lower. Again, this is back to the quality growth aspect of all the companies in the portfolio, which gives the portfolio as a whole that lower volatility profile. So in conclusion, I just wanted to finish on that sort of slide to say, this is a strategy which is trying to find long-term compounders. We think these long-term compounders are getting rarer. And so for the team, it is all about raising the odds of finding these compounders. And hopefully I have, explained how we go about it, how we aim to detect those long-term compounders, because they are rare, but they are there, and it's for us to find them. We think dividend growth is a great signal of these long-term compounders. I would also highlight that this idea of long-term compounding is nothing new. We showed here on the right-hand side the so-called Pegolotti tables after the name of a famous Italian sort of merchant who was helping wealthy Italian families to compound their wealth over many years, and he was the first to sort of put it on paper in the 1300. The positive impact and effect of compounding. So nothing new. We're trying to do the same for you and your clients, and hopefully can do that and deliver good returns with lower volatility. So with that, I'll hand back to Katrina for questions.
Great, thank you so much for that, Seb. Thank you very much for taking us through that presentation there. Yeah, we're going to be moving to some questions now, and just a reminder that you can put some questions in our chat function there, and I'll try and fit those in and ask Seb during our Q&A there. So please do put those down if you have anything to ask him. We've got a couple of questions here, Seb, so I'll just start with those, and I've got a couple of questions as well to ask you. So got a question here. I'd be interested to know what you've learned over the last few years, and what, if anything, the team would do differently next time. So it's an interesting question, a very eventful period for investors, obviously, over the last few years. Well, what have been the key learnings from the team?
Yeah, so for us, there's every year we sit down and we look at the results, published by our companies, and we look at the 5-year rolling earnings growth of those companies and dividend growth, just to try and sort out, the noise that the market gives us, every day, versus the signal that we can find in, those long-term earnings growth delivered by these companies. And so rather than, thinking at the portfolio level, we go, company by company, and we try to see, how are these companies delivering? How does this compare to our investment thesis at the time? And we try to learn from that exercise. And that means every year, we identify, a few names in the portfolio which haven't delivered in line with what we expected. And for those, typically we will do, some follow-up work. We'll try and find out, is there a particularly good reason why they haven't delivered? Could it change? And, if we come to the conclusion that there was something we were wrong in the investment thesis, or something happened within the company that now will prevent that company from delivering what we expected it to do, we would divest from that company. So rather than a general learning from the portfolio behavior over the past few years, we would look at at the company level and try to understand at each company's level, how does things change? Is it still a good investment? And then if it's not, we would divest. So it very much is a bottom-up approach. We own 54 names. We select them carefully. We try to stay away from very difficult macro calls, and that's where we do the work on these fundamentals of those companies.
Great, thank you. We've got a question here. What are your intentions regarding SDR labeling? Obviously, it's a big question for a lot of asset managers at the moment. Can you say anything about that at the moment?
So, although the fund has ethical restrictions, so 6 sectors are excluded. We also exclude companies that don't abide by the UN Global Compact standards. We don't have a sort of sustainability objective within the strategy. So we are going to be non-labeled to start with. And then, it's not to exclude, potential changes in the future. But at the moment, this is more a do no harm strategy rather than a specific sustainability objective. So we will start with a non-labeled approach.
Okay. We've got a question here. It's interesting that you are looking for low volatility, but the Morningstar report shows volatility which is higher than average. Why the disparity?
So if you look at the 3-year rolling volatility of the strategy over the past 5 years, it has been typically, lower than the benchmark, at times in line with the benchmark. So I guess it would depend on what period you look at, but more, most of the time it has been below that of the benchmark. Again, I wouldn't argue this is a defensive strategy in the sense that the drawdown would be much lower than the benchmark if the benchmark fell, but I would say that over time, the volatility has been lower thanks to the quality growth bias of the portfolio.
Okay, we've got a question here. As someone new to investing, where would be the best place to start? Now, this could be a session in itself, many sessions, I'm sure. But yeah, I mean, maybe building on some of what you were saying in your presentation. What are some of those things to look for here?
Yes, I mean, obviously these kind of lunches would be a great place to start. I think fundamentally you'd have to understand that. Yes, I mean, companies, stock market is full of sort of information, is full of noise, and it's very difficult to disaggregate the signal from the noise. And so I think if I was to start in investing, I would start by understanding how do businesses thrive, how do they grow, what is important for them, because again the share price moves up and down, affected by many different factors. But if you look over the very long term, the fundamentals of companies typically is what is driving share price returns. And so if you really understand a company, if you understand their competitive advantage, if you understand how they make money, how they have a strong competitive moat, and that helps you differentiate within the market those good companies from the bad, and then that will help inform which stock to buy. But obviously a very vast area. So but I would start with the fundamentals and understanding how these companies grow, are managed, and thrive.
Great. Well, let's look at a couple of areas as well. I mean, obviously AI has been a huge theme, a major talking point for investors this year. And how do you see AI in terms of the impact, I suppose, on across sectors, across the companies in your portfolio, and then how you're sort of gaining exposure to that theme there?
Yes, so AI is certainly a big theme over the past sort of 18 months, ever since ChatGPT really was a fantastic sort of burst onto the scene. I think we are still in a very early phase, and although we don't own NVIDIA, which has been obviously the poster child for AI, we have exposure through two types of companies. One is like NVIDIA, the picks and shovels of the AI revolution, and these are Microsoft is obviously, we believe, very well positioned, not only because they have the cloud business, which is where AI, most of AI will happen, but also they have obviously their investment in OpenAI, which means that they have exclusive access or proprietary access to ChatGPT, and they have been able to integrate ChatGPT into the software that you and I use, which means that they are the first to really be able to monetize that opportunity, and they've been doing so over the past few months or so. So we think Microsoft is uniquely positioned actually in AI. We also own Apple. We own TSMC, the Taiwanese company which manufactures NVIDIA chips, and it is thanks to their strong leadership capability that they have been chosen by NVIDIA to manufacture their chips. Just to give you an idea, on Blackwell, the latest chip by NVIDIA, there are more than 200 billion transistors. So not many foundries would be able to manufacture that piece of semiconductor, and TSMC is one of them. It has been holding in the portfolio for a while. So you have the picks and shovels, and then you have companies which hold a vast amount of proprietary data. Now, why is that important? It's important because these large language models that you hear about, Claude, ChatGPT, they've all been trained on, publicly available information, most of it in English, which means that companies, now what has become more valuable is proprietary, that data sets held by companies. So if you think of an Experian, the credit bureau company, if you think of Intuit, which provides accounting software to SMEs in the US. If you think of a Wolters Kluwer, which publishes specialist journals, they sit on enormous amount of proprietary data. And why is that important? Because they can train models on these data, which are going to be more efficient because they're just focused on a particular set of data. They're going to be much cheaper to run, and they will inevitably bring productivity and efficiency to not only the companies using those models, but also their own clients. So again, reinforcing their competitive advantage there. So we think there are the two types of businesses that are in the portfolio that will benefit from AI, which we think is quite a profound change indeed.
And we've seen some tech companies recently announced they're going to start paying dividends, and they're maybe not candidates for your fund quite yet, but they could be in the future. How have you been sort of viewing that development?
Yes, it's interesting indeed as a signal. I mean, tech is not sort of traditionally a good hunting ground to find long-term steady compounders, because it's an industry very prone to disruption. It's an industry where typically companies need to reinvest all of the cash flow to grab as much land as they can in a new area or a new technology, and so not conducive to paying steady dividends, the steady growing dividend that we want. So we have exposure to technology. I mentioned Microsoft, I mentioned Apple, but traditionally not a big hunting ground. Now, what's interesting over the recent months is the announcement by Meta and Alphabet about paying dividends, certainly a signal of maturity for these companies. So it's a signal by them that, and they feel, confident enough that they commit to a dividend. I would caveat that by, saying that for Meta, for example, they announced a $5 billion dividend for the year. They also announced a $50 billion buyback for the year. So for US companies, traditionally, particularly for the tech companies, because it helps them offset the impact of stock-based compensation, buybacks are usually a much better way of returning cash to shareholders than dividends. But certainly it is a signal from these companies.
Great. And maybe you can say a little bit more about why you're so underweight the US, and a bit about that position there.
Yes, so if you look at the fund by place of listing, we have a larger than 20% underweight positioning on US equities, because US equities, driven in part by those large cap names, the US has become close to 65% of the global equity benchmark. We don't think 65% of IDs, 65% of long-term compounders are in the US. But if you look at revenue exposure, which we think is much more relevant, because if you think of a Nestle, they're sort of domiciled in Switzerland, they're listed in Switzerland. It's not a Swiss company. So if you look at revenue exposure, the gap with the US between the fund and the benchmark is a lot lower. It's about 6%. So in terms of revenue exposure, we are very diversified, and we're certainly not heavily underweight, or not as heavily underweight as the headline numbers based on listing would let you believe.
And just in terms of emerging markets exposure, and especially looking at those companies through that responsible investing lens, I mean, there's obviously some challenges there in getting the right information that you need. And how do you kind of approach that?
Yes, it's definitely an area or a part of the market where we would have a higher bar, and certainly where we would want more comfort. We invest in some Chinese companies, and there we are very careful. We benefit from the the insights of a team, based in Shanghai. And we certainly, have more scrutiny for these holdings. So, for example, we would want to make sure, they're in an industry where, the government is not, going against over the next few years. We want them to be, we want to be sure they have, good relationships with the government. We also do, quite a lot of due diligence and try and understand their supply chain, etc. So certainly, emerging markets is more challenging in terms of the sort of ESG aspects of an investment, but it is possible, and we think China, particularly the domestic Chinese companies, have a long runway for growth, are very dynamic, very competitive. They are great businesses, and it would be a shame just to discard quite a potentially big source of IDs. Just because of a blanket ban on EM equity. So we do invest in EM in emerging markets, but we do have a higher bar, and we certainly have higher scrutiny of these holdings.
And we just got another question here. Does your portfolio include companies that can provide the energy needs by means of non-intermittent electricity providers?
So I'm not sure I understand the question correctly, but if it's about sort of do we invest in renewable energy, so we own a company called Greencoat UK, which is essentially a collection of wind farms in the UK, but that's intermittent. So that is the only sort of renewable energy company we invest in, but I'm not sure that's the question.
Okay. Just in terms of just looking at your engagement on the fund, it's obviously a very, very important part of what you're doing. How do you sort of measure effective engagement with the sort of holdings you have in the portfolio? Obviously, yes. It's over a long period of time that you're trying to have those changes and those discussions.
Yeah, so very important point. I would say one thing I would say first is, which I think is a key difference in terms of engagement, is the average holding period being about 9 years for us. So when we invest in a company, we are going to be on that same journey as them with regards to ESG, aspect and ESG challenges. So because we invest for such a long period, we have every incentive to push those companies to adapt their business model to these ESG challenges. It is very different from a market participant who is invested on average for less than 2 years in a company, essentially renting the shares rather than owning a business like we do. And I think this creates a very different incentive. Again, if you're invested for 2 years in a company, there is absolutely no incentive for you to push that company to invest today in their business to, for example, remove plastic from their packaging, or invest to reduce emissions, because over the next 2 years, it's unlikely you will see a big change and a big impact on these factors because they take a long time to happen. And on the other hand, there are costly investments in the short term. So again, in terms of incentives, there is a mismatch between the average market participants' time horizon and the companies and those and dealing with these ESG challenges. So I think the fact that we have a long holding period creates a very different conversation and engagement with companies, because they know we are going to be on the same journey as they are, and they know that we will and our clients will benefit from these changes we're asking them to move in the long run. So it's a very different conversation. In terms of measuring, again, it takes time, but I would give you an example. We own Albemarle, the largest lithium miner in the world. Been engaging with them since 2020 on becoming, the sort of the first certified sort of responsible miner of lithium in the world. Something they managed to get credit for last year, and as a result of lots of investment on their side to demonstrate that responsible aspect of their mining. And so this is, the result is, first them getting the accreditation. Secondly, Ford subsequently announced they would source lithium from Albemarle because they had this accreditation. So again, it's a great way to check the result of that engagement. What I would say is, we own tiny amounts of companies, but because of that long-term investment horizon and because we are with them for such a long time, we punch well above our weight in terms of engagement and change we can affect at these companies. And we think companies recognize that and again, give us access to, a lot more people to discuss these topics than they would to the average market participant.
And what about if it gets to the point where you don't feel progress is being made quickly enough at a company? It's not what you want to see. Presumably at that point, there's some red flags there, some extra discussion with the company. At what point then do you actually discuss about selling your holding there?
Yes, absolutely. It has happened in the past where, we engage with the company, we ask for things, we give them a clear idea of the milestone that we'd like to see. And sometimes they don't happen. And at the moment we are currently talking to a company and writing to the board to say, if these things do not happen by the end of the year, we will, likely divest. And this is the kind of things we do. But always we favor engagement and because again we think our incentives are aligned and we would not invest in a company where the management of the board wasn't clear in their head that these challenges need addressing. It's also a question of remaining relevant for the next 10 years. Again, coming back to this plastic packaging idea I mentioned, if Nestle doesn't do it and doesn't change their packaging over the next 10 years, someone else will, and then Unilever might take market share just because they're doing a better job. And so we want management of these companies to be convinced that this is the right thing to do, to ensure these long-term compounding of earnings and dividends that I keep talking about.
Yeah. And maybe you could just take us through briefly just some recent changes on the portfolio and I suppose your outlook coming into the second half of the year and going forwards after that. And obviously you're very much long-term investors, but yeah, how is the how are you positioned at the moment? What have been the recent changes there?
Yeah, so in terms of recent changes, I would mention Kering, which is a very recent sale, disposal from the portfolio, and that is following quite a lot of what we bought into Kering when in 2016 when the turnaround at Gucci seemed to be sort of taking off really, and it has been a very successful investment. But over the last few months, they had a change of designer. They've had some issues on the ESG side, and as I was saying, they've also started taking more debt, which introduces some risk. So we have divested from Kering, and we have on the other hand invested in a new company called Epiroc, which is a sort of a world leader in drilling equipment, which we think has many years of growth ahead of it, world leader and a great compounder, ahead of great compounding of earnings and dividends ahead of them. So these are very recent changes. Now, in terms of positioning, I would say typically because of the focus on long-term compounders, we tend to be underweight the more cyclical parts of the market. So, for example, financials, we typically are underweight. We think banks and insurance have very little control over what ultimately drives the share price, which is interest rates. Similarly with, very cyclical commodity companies where they don't have control of the commodity prices and the share price tend to move with that rather than what the company does. So not only are they cyclical, but also, not much you can do to differentiate the good from the bad companies. So we typically underweight those cyclical names. We typically underweight the very, large cap tech companies for reasons I mentioned, which means that over the past few months, we have really suffered in terms of relative performance. Now, in terms of absolute performance, it's been up about more than 10%, which in any year would be a good year. But obviously, compared to NVIDIA-driven sort of MSCI ACWI, this has been a relative lag. But we think giving up some of the upside in those very strong markets is almost like the insurance premium to pay to ensure resilience when more challenging, macro and market environments happen, which they inevitably will. So, and that's why we talk about the strategy as a sleep well at night strategy, because what we want to tell our clients and your clients is rest assured that Procter & Gamble, that Nestle, that Microsoft are not going to go to hell in a pandemic or in a great financial crisis. And so we want to hold these companies so that when that happens, you can sleep well at night. And if that means giving up the top end of strong market rallies, we're happy to do that.
Okay, I think we're coming close to the end of our session here today. Someone's just asked if we're going to be providing copies of the slides, and yes, I think that they'll be sent round after this session as well. So you'll be able to look back at some of what was discussed as well as the recording. But thank you so much for your presentation today, Seb, and thanks for taking those questions there. Covered quite a lot of ground about what's been happening in the portfolio and some of your longer term views there. So just before we wrap up, let's just take a quick look at those learning objectives again. They should be on the screen now. So by the end of this session, delegates will develop an understanding of a steady growth approach, understand the behavioural characteristics required to invest for the long term, and learn where there are opportunities for steady growth and dividend growth investments in the coming years. If you didn't get a question answered today, I'm sure Seb and Baillie Gifford will do their best to do this after the event, and your CPD will be delivered tomorrow as well as the recording. But just before we close, I want to give you a little bit of a teaser about some of the other PA events that are coming up. So we're on a bit of a break now over the next 6 weeks until our next digital working lunch. That's going to be on the 7th of August, where Baillie Gifford's Tom Hodges will be discussing their European fund. Then we're back on the road again with a busy schedule of events in September, starting with our ever popular multi-asset roadshow. That kicks off in Rudding Park in Harrogate on the 11th. And on the 12th, we'll be in Warrington with 3 more venues the following week, in Cardiff on the 17th, Bristol on the 18th, and rounding off the roadshow in London on the 19th. So as part of this roadshow, you'll see presentations from BlackRock, Downing, HSBC Asset Management, Quilter Cheviot and Quilter Investors. And our keynote speaker for the series is Paul Tinkler. He's Head of Insight and Consulting at De Facto. Then on the 25th and 26th of September, we're north of the border with our regular Scotland Investment Roadshow. That's in Edinburgh and Glasgow, respectively. Here you'll see presentations from 6 different groups: Bourdieu, Downing, Evelyn Partners, Orbis, Quilter, and Simply Biz. And making sense of all these will be our keynote speaker, that's Square Mile's Strategic Relations Director, Jock Glover. Then on the 1st of October, we'll be back in Warrington. That's at the Park Royal Hotel and Conference Centre with our annual PA 360 North Conference, where you'll hear presentations from over 20 industry experts, as well as having the opportunity to meet all our sponsors in the exhibition area of the conference. So do come along and network with our sponsors and your peers on what is now firmly established as the largest management conference for advisors in the north of England. So all in all, that's a total of 12 hours CPD over the next few weeks. As ever, if you wish to find more information or sign up to any of the events, you can do so by visiting professionaladvisor.com/events. So that's it for today's session. All that remains is for me to thank Seb very much for his presentation and answering our questions. And our greatest thanks, as usual, go to you for your company this lunchtime. I trust you found the session helpful and worthwhile. We hope to see you again soon, and do enjoy the rest of your day. Thank you and goodbye.